Hey everyone, hope you're all doing well. And we probably got a couple more people flowing in, but we'll go ahead and get the ball rolling here. For current members, welcome back to our weekly analyst call. And for those who are new, welcome to Reflexivity Research's weekly analyst call. We hope everyone's holding up well during these turbulent times in markets and doing well. We've got a couple very important topics that we're going to be going over this week. Firstly, starting with a macro overview and this discussion of the question of whether we've potentially seen the final rate hike from the Fed. Second, we're going to be diving into Coinbase's newly issued Wells notice by the SEC. Third, diving into rollups on Ethereum in the wake of the Arbitrum token launch. And then finally, diving into a Bitcoin native market overview with this overlying question of whether Bitcoin's potentially seeing its time to shine. So with that being said, I'm going to go ahead and pass it off to Felix, and Felix is going to walk us through an FOMC meeting breakdown as well as a macro overview alluding to this question of whether we've potentially seen the final rate hike from the Fed.
Awesome. Thanks, Will. Appreciate that. Happy to have everybody here. So obviously there's been a lot happening in the macro world the past couple of weeks. So we just wanted to start off with looking into a bit of an update on what's been happening with the FOMC meeting, and then looking into what is the status of the unfolding banking crisis that's occurring right now, and then looking at how that's starting to affect the Fed's balance sheet and just overall liquidity. So diving right into it, we obviously had the FOMC meeting last week, and the FOMC agreed to raise the federal funds rate by 0.25%. That was, generally speaking, in line with general expectations. One of the biggest, notable changes for me, and looking at the statement, is that we saw this change from they took out ongoing increases in the target range, and they actually replaced it with some additional policy firming may be appropriate. So that was really interesting to me. Within that, during the press conference, Powell emphasized to participants at the press conference that they should focus on the word may. That was really important to them. So, really what Powell's getting at here is that he's signaling that there is a chance that they do, maybe one more hike, but they're also giving themselves this new optionality to actually opt out of hiking again and actually pausing now. So for me, in terms of forward guidance and Fed speak, I view that as a pivot in terms of their guidance for the future. So what happens is that, generally speaking, we see a pivot in their guidance, and then that's followed up by an actual pivot in their policy in future meetings. So really the next step from here is to go from a pause and then eventually to rate cuts after that moving forward. So that was the first phase. The other major data point that we got from the FOMC meeting is updated summary of economic projections, otherwise known as the dot plot. So on the next slide, we just show the comparison between the dot plot in December versus March. And it's really interesting on the surface when you compare these two, it looks like not much has changed. But what it doesn't show is the fact that if we rewind a month ago, Powell himself was saying in testimony that he believes that terminal rate was going higher than what was originally anticipated. But then what happened obviously is that in the past couple of weeks, we've had this bank crisis that has brought it back down again. So even though on the surface, it looks like no change, there's actually been this big up and this big down in terms of what they foresee as terminal rate for the Fed funds. So now what we're basically seeing is that there's a median terminal rate prediction of 5.125% in 2023. And then the Fed is anticipating no cuts in 2023, but cuts slowly starting in 2024. So keeping that in mind, when we shift to what the market is anticipating, we looked at the next slide, which is just showing the dispersion between that dot plot and then this line, which is the 3-month term SOFR, which is just basically futures on cash rates. So basically what we're seeing here is that, again, the FOMC believes that we see one more rate hike and then we pause there for the remainder of 2023, only to begin slowly cutting in 2024. Now, what we see on this line here is that the market believes that basically that was the last rate hike, and then we'll begin to cut rates, quite quickly within 2023, and that, will be pretty easily 100 bips lower from here by the end of the year. So why is that dispersion occurring? And what does that imply? Well, for that to understand, we need to understand the fact that, when we put it down simply, the rates are too damn high for banks. And that is what is at the core of this banking crisis and what we're going to get into now. So basically, just to put it clear, this is not 2008. I don't think this is 2008 at all. 2008 was all about a credit event. There's very little credit or counterparty risk at the moment. It's all about duration risk. And that's being shown itself into a few different ways. So firstly, there's this duration impairment, I'm calling it. And Really what this has to do with the fact is that we've seen this regime going from 0% rates, QE and infinity money, to a regime of quantitative tightening of 5% rates happening incredibly quickly, the fastest rate hiking campaign in history. And this is causing a lot of strain on banks. So the reason that major banks have amassed significant holdings of fixed income instruments is that they anticipated is that we would see low rates for a while, and so they amassed all these treasury and fixed income holdings at times of low rates. And what I've mentioned in previous reports before is that when new debt is issued at higher rates, the price of that same tenor bond has to come down to reflect those new dispersions in rates that they can get to accurately reflect the newly available debt that's at the same tenor but a higher yield. So obviously the price needs to come down. So this means that all the bonds that banks bought with bank deposits over the last couple of years have now seen a pretty significant haircut to their value. So an example of that being is that if a bank's bond book with an average duration of 5 or so years was worth 200 or 500 billion 2 years ago, on a mark-to-market basis, that book is now worth 375 billion due to higher rates. So if they hold to maturity, that won't be an issue. What's really the big issue is that if they become a forced seller effectively. So what happens is that the spread between that $500 billion book value and the 375 billion market value only gets realized if they have to sell those securities. So this is why the Fed and Treasury came in and announced this new BTFP facility, where banks can effectively get a cash loan from the Fed using collateral of these beaten up bonds, but they're being valued at their book value of 500 billion instead of the market value of 375 billion. So really important to know that this is a loan. This is not quantitative easing. Quantitative easing is outright purchases, permanent purchases. This is a loan. That's the main difference. But it is still, some variations of liquidity positive. And the reason for that is that you can think about the fact is they're basically nullifying that spread that they're, basically nullifying is on the margin, liquidity positive. So all of that has been a one-time issue, and that's being rectified now as we speak with these new facilities that are coming out. However, it does nothing to fix what is actually, the bigger issue at hand. So basically, if we go to the next chart here, we have two lines that show a yield curve. So there's a normal yield curve, which should be positively sloping, where the longer the duration, the higher the yield that you receive. So that's that blue line here. Then there's the red line up above, which is the one that we have right now. And that is what is one of the key issues that is occurring right now, is that banks love blue yield, like the one below, where they can borrow on the short end, which is basically they take in customer deposits and provide them a small, short-term yield. And they basically can lend to other customers on that long end. So a pretty common example is a 30-year mortgage being something that they would lend long. So from this, that spread that they earn between what they borrow and what on the short end and what they lend on the long end is known as a net interest margin. And that is one of the main ways that banks actually make money. So the issue right now is that short end of the curve is significantly above the long end, as we can see in this red line, which makes for a negative net interest margin for banks. So this would significantly impair the profitability and even possibly the solvency of banks. So to account for this, what they've basically been doing so far is they've just been keeping those short ends, basically deposit rates lower than what the open market is. And they're just hoping that customers don't realize. For the past year or so, that has been true. People have just been kind of asleep and forgot about the fact that they can earn a yield in their bank account. But what's happening now with everything that's been happening with Silicon Valley Bank and all of this is it's making people rethink their strategy. And then they go, oh, wait, I can go into the money market funds and I can have zero bank risk and get, if I was getting 1% in my bank account, I can get 4.5% in the money market funds. So why wouldn't I do that and cut off my bank risk? So this is causing a major issue because there's this huge flight of deposits out of banks or going into money market funds. So this poses some significant issues for the Fed. And there's a few options of what they can do from here. Banks can raise deposit rates to closer match the available treasury rates in the open market, and that would slow the flight from basically banks into money market funds. The issue here, though, is that this would basically destroy that net interest margin that I talked about and cause major revenue or profitability issues for those banks, especially small regional ones that don't have as big of a cash buffer. So again, some of those big banks, though, like JP Morgan, they could probably be okay because they do have a huge cash buffer and they also have diversified revenue streams. They're into investment banking as well, which isn't as quite dependent as it is for regional banks. That's why we're seeing such a strain in them. So the Fed the only other option they have is they have to cut the federal funds rate. They got to bring the short end lower than the long end. So that would lower short-term rates back below long end rates and provide that positive sloping yield. And this would also stop that flow of flight from banks into money market funds as well in its tracks and start to ease the situation. So in simple terms, the Fed can either pivot and begin easing or let regional bank systems implode effectively. So, so far what we've seen is that they've been pretty quick to this trigger to come in and intervene. But again, they still have not fixed anything sizable that's going about this bigger problem here. So when we look at what's next here, really what this has to do, it has to do with bank reserves. Bank reserves represent liquidity within the financial system. So typically what happens is that the Fed aims to have a floor of approximately 10% of GDP of bank reserves. And what their goal has been with quantitative tightening over the last year is to get this level of bank reserves to be closer in line with this floor effectively. But generally, anytime those reserves dip below this 10% GDP level, this is when things start to break in the financial system. This is where we start to see those systemic issues start to arise, similar to what we saw in September 2019 for those that were there. That was when the repo market blew up overnight, and they had to come in and provide liquidity operations. Same idea. So you'll see, though, is that in this chart, we're still above this 10% GDP floor. So you might be wondering, okay, well, why has this already blown up if it looks like we are still in the clear? Well, if you go one notch deeper into this next chart here, and if you look at the difference between small banks and large banks, you'll see that there's been an uneven withdrawal of bank reserves from the system. They've been affecting small banks quicker than large banks. So small banks are actually already back down at that floor where issues start to arise. This repo spike in 2019, we can see here, which is the last time this happened. So they're already there. And that's why we're seeing these blowups in small banks versus large banks, where they're not as low into that floor yet. So they're still holding on okay. So because of this, small banks, again, they've hit their breaking point and are now under major strain. So it's for that reason that we believe that we won't see quantitative tightening for much longer, because to do that is to risk, further implosion of the regional bank system and then potential bank systems overall, eventually, once we hit that floor. So that was a quick spiel, but to put it all in summary is that the Fed has, so far only bought itself more time with these new facilities that it's run out, like the BTFP facility. These are liquidity programs that are loans, and they're different from quantitative easing. Even though they are positive for liquidity, they're not outright purchases of securities like quantitative easing is. They're loans. Core of the issue, though, is that rates are just too high. The yield curve is still inverted significantly and putting major strain on the banks. This is causing a withdrawal of bank reserves from the system, which is creating systemic and financial stress within the system. And it's for that reason that we don't think quantitative tightening will last much longer. And then again, really the only true way to fix this, unless they want to just let the whole regional bank system implode, is that the Fed needs to start cutting rates, and they need to do it real soon. So really what this means is that the Fed's calculus is around whether do they care about financial stability or inflation more. They can't fix both at the same time. They have to choose one, and they're going to have to choose one pretty soon here. My belief is that, when we've seen just how quickly they've already jumped in when they're needed and brought in, say, this BTFP facility, the Fed and Treasury have effectively shown their hand that, again, the Fed put still exists, and they will still come in and intervene when things get volatile enough, even if CPI is still already, it's still about that 2% policy goal. So it's, they're still intervening, and there's still that Fed put. So that's everything, and that's where we stand for today.
Awesome. Thanks so much, Felix. Before we move on, I'll just give an opportunity for individuals to type in the chat a couple questions. We'll take maybe 2 or 3 before we move on. Felix, we got a question that just came in. What confidence interval would you place on rate cuts being bullish for risk assets? Peter says, I ask because of the contrarian views of a few people that might not react that way.
Yeah, I wouldn't say I have a quantitative confidence interval. I haven't done any statistical analysis on it, but who has is Darius Dell. He's done some really great work where he's looked at analysis of every time the Fed has pivoted. And, when you look at the data that he's put out, it's a good time to buy. There could be a little bit more pain, but generally speaking, it has been bullish when you look back at the back tests. Those aren't my back tests myself, but Darius Dell is pretty legit, and I definitely trust his analysis. So I'd recommend to go check out what he's done. I definitely agree with it.
All right, awesome, Seth. I'll pass the mic off to you.
Awesome. Yeah, if you want to just slide one slide forward for me, see what you got on there. Reflexivity's been covering all of the regulatory developments that have been going on, particularly in the first 3 months of 2023. It has certainly been a tumultuous 3 months. This week is no different, with Coinbase and Binance very recently being hit with different levels of lawsuits by different regulatory bodies in the United States. First, we're going to talk about Coinbase. On Wednesday of last week, Coinbase was hit with a Wells notice by the SEC. An investigation into Coinbase has been ongoing since 2021 by the regulatory body. A Wells notice means that certain individuals in the SEC will be recommending to the commission as a whole that a lawsuit should be pursued. In many cases, the Wells notice is nothing more than a formality, and a lawsuit is usually imminent. In terms of a response by Coinbase, their legal team released a very lengthy response on their website, in which they stated that Coinbase intends to continue all operations as normal, and that they welcome their day in court to speak for the crypto community as a whole. Coinbase's intention to continue operations as normal is slightly different than what has happened in the past, particularly last year when Coinbase delisted Ripple from their exchange. So I think it's interesting to note that they intend to continue as normal. Coinbase also included the Wells notice itself that the SEC had sent, which normally is not released, which I thought was a great positive. The Wells notice itself was very vague. It didn't mention any specific aspect or product offering related to Coinbase, but in Coinbase's response to the notice, they believe that the alleged violations are related to certain assets that are listed on the exchange, their staking service, and Coinbase wallet. The SEC in recent months and a bit perhaps over the last year has been able to pick off quote unquote weaker members of the crypto herd. But Coinbase, being one of the largest crypto institutions stateside, certainly has an ability to fight this suit all the way up into the highest courts of the land. We believe that while an attack on the largest exchange in the United States can seem like a net negative on the surface, it could be an eventual net positive that we could finally see some of the issues that this community has been clamoring about for months, finally get to see their light on the public stage. Coinbase, in their response, had claimed that they've been trying to comply with SEC guidance for over a year now. They had over 30 meetings with the regulatory body, but they had ultimately been stonewalled at every chance they had of interaction. The regulatory agency reached out to Coinbase at the beginning of their investigation in 2022 to look to make a collaborative effort in regards to creating a registration framework for cryptocurrency exchanges. That framework simply does not exist. Coinbase claims that they'd spent millions of dollars and hundreds of hours of manpower to create different proposals about how they could register underneath current SEC regulatory frameworks. But the SEC decided ultimately that they did not want anything to do with that and were shifting to quote unquote an enforcement investigation instead. Something I think of note in the response as well is that Coinbase believes that federal judges have started to grow weary of the SEC's classification battles in relation to different crypto assets. They cited quotes from the judge in the current case involving Voyager, a now defunct crypto brokerage firm, in which the judge had stated that the SEC needs to really come together with the other regulatory agencies, particularly the CFTC, and start to create clarity in regards to the classification of different crypto assets. This point we'll hit on when we talk about Binance in a couple of minutes. And as with every lawsuit that we have detailed here at Reflexivity in the last few months, the XRP versus SEC case looms very large in determining any outcome regarding Coinbase. If Ripple wins their case and XRP is not deemed a security, the SEC's conjectures about certain listed tokens on Coinbase are certainly weakened. And now Binance early this week were hit with a lawsuit by the CFTC. The regulatory body alleges that Binance and its CEO violated multiple US commodity laws by amongst many other things, secretly coaching VIP American customers on how to evade compliance controls using VPN and other technologies. The CFTC can't bring criminal charges to the firm, but it can seek heavy fines and potentially ban Binance from registering in the US in the future. That is the language that we see in the lawsuit that was brought apart on Monday. Something that I think is really important to note in this context here is that while the SEC has had no problem picking off small crypto-related firms in order to enact its legislation by enforcement or regulation by enforcement, the CFTC has rarely sought small cases. They are certainly big game hunters. An example being Bitfinex in 2018, BitMEX a couple of years earlier. Usually the CFTC, when they have opened up any sort of lawsuit against a crypto-related firm, they have not lost. They usually extract very heavy penalties. There are many that believe that the CFTC put out this lawsuit not just for regulatory efforts, but also for political gain. A key component of the case is that the CFTC labeled Bitcoin, ETH, and Litecoin as commodities, marking a stark contrast from the SEC and the New York Attorney General in their case against KuCoin. Experts believe that the SEC may actually file a case of its own against Binance just to label the assets securities instead. There have also been talks of the Department of Justice also opening up a case against Binance, particularly because in the CFTC lawsuit, they alleged that Binance knowingly processed payments for Hamas, a known terrorist group operating out of the Middle East. Something I think to wrap up that I think is very important for the context of both of these lawsuits is within the response by Binance. Binance's CEO released a response this morning, and while Coinbase released a very thorough and strong statement coming out in defense of their own products, the CEO of Binance released a very short statement. It claimed that their protocol to block US users is more robust than any other exchange that exists globally. But beyond that, it did not do much to quell many of the allegations that the CFTC brought forward. I see there's a question in the chat wheel. It looks like some people answered it as well. What impact with the CFTC and Binance overall have the crypto currency markets? That can be a black swan event. I certainly believe that the perhaps closure of the largest exchange globally for cryptocurrencies would constitute a potential black swan event. But I think something that should really be taken note of, and something that I don't think is spoken about or has been spoken about enough in traditional media and on social media, is that these processes take a long time to find their conclusion. When the CFTC opened up their lawsuit against Bitfinex in 2018, that lawsuit took 2 years to happen. And so we haven't quite seen the even first order effects of these lawsuits yet. So I wouldn't go so far to call it a black swan event.
Yeah, I think just to tag on to that also, adding in a few other thoughts, in the immediate term, just, low-hanging fruits, would be declining volumes, declining liquidity, things like that. Seth, we've got another question from Justin as well.
Yeah. Specifically regarding Bitcoin, Gary Gensler has been very clear that Bitcoin is the only asset that he sees as a security. Beyond that, I cannot necessarily speculate on what the SEC's end game is. In the report, we put a tin hat on for a little bit and discuss the idea that perhaps the SEC and the CFTC are perhaps trying to suppress the adoption institutionally of crypto assets so that more incumbent firms can enter into the space. We saw recently news of NASDAQ opening up a custody product offering in the scheduled to release in the back half of Q2. It certainly seems interesting, to say the least, that NASDAQ, an institution that has worked with the SEC and the CFTC on numerous occasions, is willing to come up with a custody product while those regulatory bodies are tearing down the current industry of custody and exchange offerings one by one. There has certainly been a lot of talk about Operation Choke Point 2.0, and I think Nick Carter has really done a good job on his own detailing the coordinated attack on the access to traditional financial institutions on his own, and so I'll let his work speak for himself.
All right, awesome. Thanks so much. That's super insightful as always. I'm going to now pass it over to Ashu, who's going to walk us through the state of Ethereum rollups. Felt like this was a pretty relevant topic with the recent Arbitrum token launch.
Yeah, hi. So yeah, excited to have everyone here. As Will mentioned, just with all the excitement around Arbitrum, we thought it would be timely to just do a sort of brief high-level overview of the current state of Ethereum rollups. So just to sort of set the stage, why do we even need rollups for Ethereum? Well, this goes back to the basic blockchain trilemma, which is that there are trade-offs that have to be made between security, decentralization, and scalability. In general, you can only pick two. So in order to scale the blockchain and ameliorate the congestion on Ethereum, on the Ethereum layer 1, which kind of manifests itself as high transaction fees and low throughput, developers the Ethereum core developers have chosen an Ethereum rollup centric roadmap for Ethereum. So what do rollups do exactly, or how do they work? So rollups scale execution vertically. This means that they process transactions on their own blockchain and then submit them as a single transaction, a batch back to Ethereum. That offboards execution, increases throughput, lowers fees. It reduces congestion on the Ethereum layer 1, but it keeps its robust settlement, security guarantees, and data availability. So right now, the main two rollups that have most of the activity and value are Arbitrum and Optimism, which are both optimistic rollups because they optimistically assume that all transactions are valid. To do so, they do have to leave a week-long challenge period after they post a batch, where users can, or validators can, dispute the validity of transactions. So it does introduce some hurdles, some user experience hurdles, but optimistic rollups have really done well because they have EVM compatibility out of the box. So, a lot of EVM developers, EVM apps, they've been able to just sort of fork over their code or quickly build out new projects. And so Arbitrum and Optimism have really been, so rollups more broadly, but again, Arbitrum Optimism have about 90% of the value held on rollups. So they have been real bright spots during 2022. Despite the lower fees on Ethereum L1, they doubled the assets held on chain in ETH terms. So basically net of prices, they had still pretty substantial inflows, even though they weren't as needed. So right now in their current state, they're both pretty similar. They're both EVM compatible, settled to Ethereum, obviously. They both require ETH for transactions, batch transactions using centralized sequencers, and they both have their own native tokens now. I think the one big difference is probably just Arbitrum's superior security guarantees. So it does have a fully deployed fraud-proof system, and it does have a validator set. Validator set is permissioned right now. So they have 9 validators, but yeah, they just look to be sort of further along, and again, just less trust required marginally. And then I think the other area where Arbitrum does on its sort of technical front outdo Optimism is just its throughput. So it's about 20 times the throughput right now with 40,000 transactions per second TPS versus and then it has about it's usually about 25% lower in terms of fees than Optimism. So that's sort of the state right now. I think so. Moving beyond just that underlying technology, if we actually go to their sort of traction and growth strategies, again, or actually, so unlike the technology, very different. Optimism has spent millions of dollars on incentivizing usage. Their summer incentives, Optimism quests, whereas Arbitrum has done basically none of that. They did have a short Odyssey campaign, I think in July 2022, but that was about it. So yeah, and the really crazy thing there is that despite that, Arbitrum has actually outperformed Optimism on basically just about every metric. So daily active users, transactions, where it's actually recently just flipped Ethereum as well, the Ethereum mainnet L1, contracts deployed, total value locked. So yeah, Arbitrum accounts for about 2/3 of TVL for rollups. So it's a pretty dominant there. But I think the one area where Optimism has done marginally better, or actually meaningfully better, is just long-term retention. So over 6 months, in terms of user retention. So it's about 10% higher than Arbitrum. Arbitrum's about 30%, and Optimism is at about 40%. But that could just be because of how long their incentives have gone on for. So still kind of TBD, but they have had longer user retention. So yeah, I mean, I think just overall it's going to be worth seeing if like a lot of this Arbitrum activity was just because of vague hints on airdrop, and so people were really just using the chain because of that. Because in some ways it doesn't make sense otherwise, because if you just look at it, I mean, Optimism generally has a better user experience. It's much more integrated with a lot of the sort of high profile trusted Ethereum dApps like Synthetics and Uniswap from earlier on. And it also has a developer grants program. So just in terms of a lot of kind of bells and whistles, it has been better. So I guess the second point here now is just kind of diving into the ecosystems. They are pretty different, as you'd sort of expect, just given their strategies, their different growth strategies. So Arbitrum, for Arbitrum, over half, roughly 54% of their TVL is on native applications, which means those that were just directly launched on Arbitrum or only have versions on Arbitrum. Whereas for Optimism, that same number is 29%. So again, as mentioned, just their incentive programs and just their BD team, how they worked, they brought over a lot of Ethereum dApps early on. So they didn't really have a chance to sort of foster their own native ecosystem. And what is there of their own native ecosystem is also, again, mainly just backed by large VCs. Think like your A16Zs, Multicoins, Polychains. And so, yeah, Arbitrum, again, implications of that is just Arbitrum has a very sort of degen friendly ecosystem. So high risk, high leverage products. You have perpetual exchanges are really popular on there, GMX, Vela, Gains. You have gambling platforms. It's really those have really taken off as well recently. So Arcadium, BetSwirl, and then also levered yield farming strategies using Radiant, Tender Finance. So yeah, I think again you can just kind of point that ecosystem growth and development back to the lack of incentives and also the lack of VC funding. So instead of kind of having this like hazy vision for future adoption, it really forced developers to focus on creating things that users would actually use and they actually wanted, that they couldn't easily access off chain. So that's one aspect of it. And then another one is just you sort of have this reflexivity within that, where these community funded projects, the profits from them quickly flow into other super experimental projects or high risk strategies. So yeah, and then I think the final point there is just, I think Arbitrum has another chance now to cement its lead with the recent ARB airdrop. So, basically just a $1.5 billion liquidity injection. So we'll see how that plays out. And then also now those Arbitrum tokens, a lot of them were given to DAOs, so they can actually incentivize usage and development. And the treasury got 43%. So again, just usage development. There's a lot of white space now to really incentivize that. And then in terms of scaling and roadmap, this is a spot where I think Arbitrum comes ahead again. So I think Arbitrum Nova, which is their sort of very, very high throughput, very low fee chain, more oriented towards, say, GameFi, social, NFTs, that has kind of started to actually gain some traction. It was launched back in August 22, but now you've had OpenSea launch on it. You've had Treasure, pretty popular GameFi DAO and Studio. So I think that's promising. And then that combined with Stylus, which will allow, so it's going to move outside beyond Solidity and allow developers to basically just create applications with for any sort of traditional programming language, C, C++, Rust. So you can bring over Web2 developers, gaming developers, Solana developers who are used to building these sort of consumer-friendly applications. And then I think the second really interesting, actually probably the most interesting roadmap item is just Orbit, which was announced in tandem with the ARB airdrop. So I think it was sort of overlooked by a lot of people, but this was a really big deal because if anybody here has read the Endgame by Vitalik, it's basically this idea that you're going to have like millions of these custom application specific modular blockchains, just like the same way you have millions of web pages. And so Orbit, what it's doing is it's offering rollups as a service in the same way that Amazon Web Services, Docker containers, Kubernetes, like all these things abstract away the complexity of launching web pages, hosting servers, scaling up web applications. These rollup as a service providers, Arbitrum now, along with a few others, they plan to create a similar experience for just spinning up and maintaining blockchains. So I think that this is super promising. Basically, it's going to create, developers will be able to create layer 3 chains, and they're going to be deployed on and settling back to the Arbitrum L2. So that's one sort of value accrual method for the ARB token, because they will be paying the sequencers. And then a second one is, so in order to fork the Arbitrum code base, they'll need DAO approval, and then developers will have to pay licensing fees. So pretty strong value accrual from two different angles. And that's as opposed to Optimism, which is also launching the OP stack, but that's not really a rollup as a service offering in the same way. It's not an L3. It's more about just being able to fork Optimism's code base, and they're turning Optimism's code base to be modular, which is actually really advantageous just because of how much this landscape is probably going to change and all the new technical developments. But yeah, the monetization just isn't there because anyone can fork the L2 permissionlessly, but they can opt into using Optimism's security model, the sequencer sets. So like Coinbase, for example, didn't, and they've opted to donate 20% of the revenue back to Optimism, but there's no guarantee that other projects will be as generous. But I do think Bedrock in general, though, is definitely a big step up for optimism. So again, like as mentioned, just their modularity, like separating those different layers, consensus, execution, settlement, data availability, that allowed them to quickly iterate on design going forward, especially with ZK rollups coming. And then I think the second point there is just like better performance, closer to Arbitrum in terms of fees and throughput. So Bedrock overall it's definitely a positive development. And then just some other stuff I think to keep an eye on is one, seeing how Arbitrum and Optimism actually finally decentralize their sequencer sets and fully deploy permissionless fraud-proof systems. I think another one is Coinbase's base and how that plays out, because it's going to be built using the OP stack, as mentioned. I think another one for Arbitrum that can kind of be a risk is just how much how concentrated activity and TVL is on GMX and the kind of like GMX GLP ecosystem. So I think GMX is about 25% of TVL right now on Arbitrum. And then Arbitrum will be moving their governance, their just ecosystem governance from off-chain labs to the Arbitrum DAO, which is basically just it's Arbitrum token holders. So over time, seeing how that plays out and how much off-chain labs actually, how much rope they actually give will be interesting to see. And then I do think that because of stronger just fundamentals and value accrual for ARB, I do think the fully diluted valuation should diverge. It's like there's about a $3 billion difference right now. I think it's 9.6 for the OP token, and for ARB it's about 12.7. So I do expect that to keep diverging, but yeah, that's to be seen. And then I think finally it's just, especially for the optimistic rollups where they have this week-long withdrawal delay, it will be interesting to see how the sort of interoperability solutions evolve. So like one, just moving assets safely, fluidly, basically just bridging. How is that made more secure? How is that made more efficient? But then also kind of some of the cross-chain messaging stuff. I think that'll be really interesting to watch. And then, I mean, in general, just longer term, I think, Vitalik and the Ethereum core developers, and I think a lot of people think that optimistic rollups might just end up being a footnote, and it's all just going to be about ZK rollups, zero knowledge rollups, where they use validity proofs instead to ensure errors don't occur in the first place, as opposed to like having these long arbitration periods to correct errors. And obviously, they also offer privacy, which is huge, especially for kind of some of these enterprise blockchains or enterprise potential enterprise users or adopters. And then, yeah, I mean, I think the other thing about ZK is just how much they can also increase throughput, lower fees, because they only need to put the state difference back to Ethereum. So that's another huge advantage for ZK rollups. But they're also really hard to make, especially with EVM compatibility, because developers need to create validity proofs for every type of transaction. So yeah, they have been a little slower to launch. With that said, I think EIP 4844, which is proto-dank sharding, will be much better for their performance, and that's slated for the back half of this year. And I think that we've also, I mean, just starting last week, seen a lot of tangible steps to launching ZK EVM. So ZK Sync, they launched the alpha mainnet of their ERA ZK EVM. So that's actually the first ZK rollup to get on mainnet, and they do have a lot of guardrails in place. But they're also going to offer a rollup as a service model with hyperchains, and there's a lot of excitement around like account abstraction and their DeFi ecosystem. And then Polygon ZK EVM also launched actually yesterday. So that's pretty huge as well. And then you have like PSE, Tycho, Consensus, Scroll all coming up. So yeah, it's rollups are an exciting space, exciting place to be. A lot of nuanced differences in their design, scaling strategy, value capture culture, but definitely going to be really important for the future of application development and user adoption on Ethereum.
Thanks so much, Option. Super insightful. We have a question here in the chat for Eric. To read it out so the audience has context, Aaron asks, what are your thoughts on the OP stack its vision, and what it could potentially enable. Oh, apologies. Looks like I accidentally muted Ashu. Sorry. Ashu, I just unmuted you.
Oh yeah, no worries. Yeah, thanks for doing that. Yeah, I actually think that that's a really good analogy. I think that, yeah, those are very comparable because Cosmos shared security model is also opt-in. So that's sort of been, a lot of people have talked about how that's kind of a point against sort of atom value accrual, just because a lot of these chains aren't going to choose to opt in. So yeah, I think that's one thing. And then another similarity there is that instead of settling, the L2s that are spun out of the OP stack are going to settle to Ethereum itself. So again, yeah, you're going to have them. They'll probably have much more flexibility in terms of how they design, in terms of their design, in terms of kind of application specific design and features that they choose. So again, that's more similar to the Cosmos SDK and Tendermint, where people have a lot of white space to choose how to design these different blockchains.
All right, awesome. Thanks, Ashu. If there's no other questions, we'll go move on to the last segment, which is whether this is Bitcoin's time to shine. It's no secret that Bitcoin has outperformed almost every asset class, as well as all the majority of the kind of sizable crypto assets in the space. Looking here at kind of the year-to-date performance, you see Bitcoin's up almost 60% on the year, gold's up just over 10%, the NASDAQ hovering right around 8% on the year, the SPX essentially flat, and the TLP down 2%. So the question is, what's been driving this performance for Bitcoin? Of course, with all the banking turmoil, a lot of Bitcoin natives, including myself, have been kind of pounding the table on, this is what Bitcoin is built for. But in reality, is this just kind of individuals looking to front run monetary policy and just viewing Bitcoin as kind of the fastest horse that will benefit the most off of the kind of shift in monetary policy, or are people actually viewing Bitcoin as somewhat of a safe haven? To try to unpack this question, first of all, we can look at the correlation of Bitcoin to the NASDAQ. This is historically the clearest correlation between any asset and Bitcoin. Currently, as you can see, we're in a very high period of correlation. But when we look at gold, we can see that the correlation is actually even higher. And this is actually the highest correlation to gold that Bitcoin's had on the daily time frame in several months. On a year-to-date basis. I don't want to misspeak in terms of the going back exactly, but I believe on going back looking at least over the last 6 or 8 months, this is the highest correlation to gold that we've seen. And when we look at Bitcoin's market dominance, so essentially we look at Bitcoin's market capitalization relative to all the other crypto assets in the space, we can see that Bitcoin's market dominance has been climbing. And so what this indicates, along with the next chart, which is looking at Ethereum relative to Bitcoin, we can see that Bitcoin's been drastically outperforming all of the major crypto assets. And so, why is this important? We can see that, kind of the fat tail assets that, if you kind of think of the risk curve, you essentially, you have Bitcoin being viewed by a lot of, traditional hedge funds as essentially, risk on asset. And then, as you go further out on the risk spectrum, you have Ethereum, and then you kind of go down the market cap of, go down the risk spectrum of all the different crypto assets. And so, what this is an indication of, when you kind of pair this with the high correlation with gold and the relative performance to other crypto assets, is that individuals aren't just going down the risk spectrum. So if this was a kind of, risk on type of driven behavior to drive flows into BTC, we would likely be seeing that also translate to relative to performance to Ethereum and some of the other crypto assets. We can also see this in the derivatives market as well. So when we look at open interest, here we have a chart called open interest dominance, essentially looking at between Bitcoin and Ethereum, the percentage of overall open interest. For anyone who doesn't know, open interest just reflects the total number of futures contracts that are out there. Particularly here, we're looking at perpetual swaps, which are the most liquid product in Bitcoin for a variety of reasons. The biggest one is just that they offer cheap access to leverage for individuals. As you can see here, we've seen this slight divergence over the last few weeks of Bitcoin's kind of open interest dominance relative to Ethereum's climbing. And this is even more prevalent this behavior when we look at the perp volumes. So if throwing a 7-day moving average here, as you can see, in addition to open interest, trading volumes for perpetuals on BTC and ETH are definitely diverging over the last 2 months. You can see that ETH's kind of perpetual volume dominance has been declining, while Bitcoin's has been climbing, while Ethereum's clearly been declining. So when you kind of put these factors together, we can paint this picture of high correlation to gold. We can see that on a relative basis to the other crypto assets, Bitcoin is clearly outperforming. And also looking at some of the derivatives data, including open interest and volume, Bitcoin is clearly leading the way. We move on to looking at a couple other key kind of derivatives metrics that we follow here at Reflexivity for the crypto market. Here we're looking at the annualized rolling basis for 3-month futures relative to spot. So essentially what this is looking at is the difference between the 3-month futures contract and the current kind of marginal trading price for spot BTC. As you can see, going back to kind of the beginning of 2021, this was a great indicator of kind of the euphoria and exuberance that was taking place. You could long spot short futures and lock in a 45% yield annualized at the time. Of course, this was not sustainable by any means and marked a high amount of leverage in the system. We saw another kind of sharp rebound in the back half of 2021. But more importantly, what I want to kind of have everyone take note of is if we look at over the last month or so, we've had this really aggressive rally in Bitcoin. But despite this rally with the 3-month futures basis, it's been relatively muted. So we haven't really seen that kind of behavior translated into the futures market. And also when we look at the perpetuals market, particularly here looking at funding rates, this is essentially the payment that longs and shorts are paying each other every 8 hours, and is a good gauge of kind of the aggression and positioning of individuals in the perpetual swap market. We can see that in addition to the 3-month futures basis, the funding rates for perps have also been relatively muted for the size of the move that we've seen. A 45-50% rally in BTC and very muted funding rates in 3-month futures basis is a positive sign, because pairing those things with also something called cumulative volume deltas, we can see that spot cumulative volume deltas relative to perpetuals on both coin and stablecoin margin contracts have shown that overall the picture I'm trying to paint here is that this rally has definitely been spot driven relative to some of these other rallies that have been not sustainable for Bitcoin, that have been driven by essentially leverage, and particularly in the perpetual swaps market. When we move on to some kind of Bitcoin, what I like to call Bitcoin native valuation metrics, we'll look at a couple of these. The first one that I think is noteworthy is the Quell multiple. So the Quell multiple looks at Bitcoin's issuance denominated in USD terms relative to its 365-day moving average. Essentially, from a first principles basis, what you're looking at here is a gauge of the amount of revenue that miners are bringing in. And so historically, whenever we get into this kind of green zone there at the bottom, that indicates a good time to accumulate, because it shows you that miner revenues are extremely low relative to kind of their trailing 365-day moving average. And of course, we've moved out of, not only have we, reached that kind of zone of undervaluation, but we've now pushed out of it. And second, here we're looking at MBRV Z-score. So to break this down, we're looking at Bitcoin's market capitalization relative to its realized capitalization. Realized capitalization looks at the total amount of BTC multiplied by the price that they were last moved. Then if we divide that value by circulating supply, we essentially can get the cost basis in an aggregated sense of the entire market. Looking at that relative to kind of the marginal trading price, we can, from a first principles basis, what we're looking at here is what is the current trading price relative to the cost basis of the market. And so, of course, whenever, in a bull market, the kind of marginal trading price varies very greatly to the upside from that kind of cost basis of the entire market. you have a very high incentive for individuals to realize profits. And that's what takes place at the peak of bull markets, and of course puts the top in. And then when we get down into the bear market, the green zone that's highlighted there at the bottom, the previous one in the P/E multiple was a bit arbitrary. This one is not. This is showing you whenever that marginal trading price goes below that kind of aggregated cost basis. So what does that mean? That means that the market in aggregate is underwater whenever we see the MVRV metric here in orange dip into that green zone. And so once you're in that green zone, historically, that's marked a great time to accumulate. But from kind of a momentum perspective, or someone who's looking for confidence that the market has put the bottom in, historically speaking, pushing out of this kind of accumulation zone there in the green has been a sign that Bitcoin's bottomed out, at least kind of on a intermediate time horizon. We can see that there after 2012, after 2015, after the 2018 bear market, pushing quickly out of the accumulation zone there, and the COVID crash of 2020, and recently we have seen a kind of decisive push out of that. On a similar note, we can look here at the long-term holder MVRV specifically, kind of same general concept here, just specifically looking at long-term holders instead of the aggregated market. Next, we're moving on to a metric called net realized profit and loss. Essentially what we're looking at here is you take the aggregated sum of the last time that coins were moved relative to when they're being moved now. So if I last moved the coin at 30,000, well, here's a better example now that Bitcoin's now near 30,000. I've last moved the coin at 40K and it's now moved at 30K. That coin's realized 10K of realized losses. If I last moved the coin at 10K, I'm now moving it at 30K, it's realizing 20K of realized profit. And so we can take the aggregated sum of this, on every day, and then we can kind of look at the delta between those two, and you get essentially this raw value of the net realized profit and loss of the entire market. This is a great metric to look at, but what we do here with this chart is adjust it for market cap, because of course you're going to have more losses and profit being realized over time as the kind of size of the Bitcoin market and liquidity grows over time. So this divides that net realized profit and loss value by market cap to kind of get this relative basis, and that's what the oscillator is showing you here. And so as you can see, we've reached kind of on a relative basis to historical values. What in my opinion is kind of sufficient capitulation from both a kind of depth perspective as well as a time perspective. And it does appear that we're likely within the next week or so going to be pushing into a state of net realized profits being realized for the first time since kind of the back half of 2022. Next, we're looking at a metric called SOPR. This is spent output profit ratio. Very similar. We're essentially looking at the last time coins were spent relative to where they're being moved now, and very similar kind of as a gauge of profitability, seeing that that's starting to push into a territory of net profit being realized. So we looked at a couple of these kind of what I would say are kind of blockchain native valuation metrics. Moving on to a couple of momentum indicators. This first one is the short-term holder cost basis. It's something that I've posted a fair amount on Twitter. Essentially what we're looking at here is applying that realized price that we talked about a couple slides ago, specifically looking at market participants that have been in the market for less than 155 days. And so when we kind of look at this on a multi-year view, this actually served as a pretty actionable kind of momentum indicator on a high time frame view. So when we look historically during bull markets, this has served as kind of a bull market support band. And then as you kind of flip back into the bear market, you've seen several very clean underside retests, basically showing that it's flipping from support in the bull market into very clean resistance into the bear. And then once you're able to kind of reclaim and retest that, that's historically marked kind of a shift in momentum. Applying that to kind of current circumstances, as you can see, this has been resistance since the back half of 2021. I remember watching the price go below this in real time in the back half of 2021 and posting it on Twitter. It's great to finally see us make a pushback above that. But what's even more exciting is finally seeing that getting retested as support, essentially as confirmation. So from a historical precedent, this is a positive indication that perhaps we're seeing a kind of shift in terms of momentum for Bitcoin. And then the last two metrics that we'll look at here, first of all, the 200-week moving average. This is something that I feel like is pretty widely used across the entire Bitcoin community as kind of a gauge for historical Bitcoin market bottoms. Of course, what we've seen that's been different to relative bear markets historically is that we've seen several months that we've traded now below that 200-week moving average, but we've finally seen a decisive push above that in 2 weeks. So I think that's something to definitely take note of. And then also when we look at the 200-day moving average, as you can see on a relative basis, we kind of have this oscillator here set to the historical values that Bitcoin's marginal trading price has deviated from its 200-day moving average. We can see that it's now pushing out of this gauge of kind of undervaluation. So to kind of summarize, I know we're now running over a few minutes on time, but for the first time over the year, I think Bitcoin's got a very clear kind of narrative with all the bank bailouts, and as Felix kind of highlighted at the beginning, a potential shift in monetary policy that's highlighted Bitcoin's value proposition as this kind of decentralized counterparty riskless asset. And when we look at a lot of these kind of valuation metrics, we're finally seeing Bitcoin push out of these levels of deep value, early signs of momentum being reclaimed. And in the derivatives market, we're seeing that this rally recently has been primarily spot driven rather than derivatives. We've seen with some of these other kind of shorter term lived rallies for Bitcoin over the last year and a half or so. So I think on a kind of 8 to 12 month time horizon with the halving just over a year out, things are looking up for BTC. Before we wrap up, I just want to mention that we hope that you enjoyed the time over the last hour. We really appreciate everyone joining. We're throwing out a discount for everyone that's on the call today. If you go on our website, go to checkout and use the discount code Bitcoin, you can get 25% off any subscription on a monthly or annualized basis. But regardless, we appreciate everyone joining the call today, and we hope to see you soon.